Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger Associates Financial Planning. Glad to be joined here by my co-host today, Kyle Ryan, also a certified financial planner as well as a chartered financial consultant. Thank you, Kyle, for joining me again.
Thanks for having me.
So we are on the third part of a three-part episode or whatever on Social Security. As I pointed out in the very first episode, I did this 3 years ago, but the difference between then and now is we're 3 years closer to sort of the D-Day of when this benefits will likely change. But the benefits likely changing, but certainly there's going to be a change.
Somehow there's going to be a change.
Something's got to change.
Yes.
Okay. So anyway, in the first episode, what we talked about was the history of Social Security, the history of the tax withholdings, the whole calculation of what the primary insurance amount is for full retirement age, and the types of benefits. Then we moved into the second episode and we talked more about, in detail, of the three different types of benefits, mostly, actually the four. We talked about the disability benefit, we talked about spousal benefits, survivor benefits, and the retirement benefit that most people think about with Social Security. Now we go back to that. And we talked about the ramifications that if you decided to take Social Security earlier than your full retirement age, what the income limitations are and what the reductions are. The one thing we forgot to talk about is the children's benefit, which we'll talk about real quickly. But in this episode, we're going to talk about, in the first segment, what are some strategies, okay? When should I apply and some strategies behind it? And in the second half of this episode, what we're going to do is we're going to talk about the taxation of Social Security, which it could be an episode all by itself.
At least we took the easy ones.
So anyway, so let's talk about the kids' benefit. Forgot about it, okay? We forgot about to talk about it in the last episode.
Well, yeah, we started a little bit just kind of saying, if you have a deceased parent or a disabled parent, you're under the age of 18 years old, your child is actually eligible for a benefit. It's up to 75% per child of what your full retirement age benefit is if you are were deceased or if you're disabled. So each child can earn up to 75% of that benefit, but there is a family maximum because if you have 10 kids, you're not gonna.
Right.
You probably end up offering the dad just so everyone can start getting money. But so the benefit limit is 175% of your full retirement age. So it's a way of providing to the family of someone who is deceased, disabled,
Right.
if you have young children.
And the other thing too is that the spouse also gets a benefit of 75%.
Yes.
So again, there's a family limit, but and the spouse gets the benefit as long as there's a child under the age of 16.
Yes, it's different
Okay.
than the children's benefit.
Correct.
Yep.
But I'll use an example of one that I did. I had a client. He was 64 years old, had just retired, or we talked about this before he retired, but he retired, and he had a child at 12. Okay, his child was 12 years old.
Okay.
And he's 64.
Yeah.
Okay. Okay. God bless him. 52 years old when you're having a child. Okay. Be that as it may. So I said, I won't use his name. I said, are you aware of the fact that if you begin to collect Social Security, your child gets Social Security until he turns age 18? And he said, well, sure. Now, we may not normally have someone take the benefit at age 64, but in this particular instance, it clearly made sense because what we did is we doubled up the benefit.
Yeah.
Okay, so he got his benefit, and his child, who isn't even 18 yet, has already accumulated like 80 grand in a savings account for monies that were collected from Social Security, which quite frankly, that's a shot in the arm for whether they decide to go to a trade school, college, or whatever. That's a nice little pop of money.
It's a good way to get started.
It's a great way to get started. So I left that out. So anyway, so let's talk about some scenarios of when do I take it? And this is the question we get all the time. And when we're doing comprehensive financial planning for clients, we also make sure that we discuss this. So again, we're all about the educational piece. So what we'll do is we'll explain to the clients that chart that I created and say, all right, how should we apply this to you? Well, let's start with a single individual.
Before we even get there, I would start by saying the only way to know for sure if you're going to make the right decision as to maximizing your Social Security is if you know the day you're going to die.
Right.
So all you're doing is, which you're not going to know that, ideally. So all you're doing is really a best guess, but those who know the rules of the game tend to play it better. That's why we want to go through different case studies, different examples of how we rationalize when we talk with clients when they should apply for Social Security.
We'll start with the single because that's the easier one. Okay? So if they're full retirement age 67, and let's say it's $1,000, everything's relative. So if it's 1,000, 3,000, doesn't matter. If their age 62 benefit was 30% less, it'll be 700, and their age 70 benefit would be 24% more, 1,240. So what we've done is we've done break-even analyses, and we say, all right, what if he began to take it at age 62? At what point in time does he break even? Well, basically what happens is that from age 62 to age 67, they're collecting $700 a month. That's $8,400 a year times 5 years, 42 grand. So how long does it take them until they catch up? If they waited, how long does it take them till they catch up? And they catch up at age 78 2/3.
Yes.
Okay? But what it doesn't take into consideration is what if they invested that $700 a month? Well, okay. The reality of it is that most people aren't if they're collecting it. But if they are investing it, well then great. We can just do some math and say, how much would it grow?
Yeah.
And what's the break-even age there? But to your point, and I know you're getting to it.
Different side of the same coin. If you're getting Social Security income and you don't have to take out of investment accounts, which are earning X% on average per year, that also extends your break-even age.
Correct.
Because now it's allowing your money to continue growing without you having to interfere with the growth in your investment account.
Correct.
So it's two sides of the same coin.
Correct. And if you were to earn 5% on your money, your break-even age is in your 90s. If you earned 7% on your money, the break-even age is over age 110.
Yes.
So, a lot of folks out there say, well, gee, you know what? I should be able to do that. Even 5% I should be able to do reasonably well. Yeah. We're not here to promote one thing or another. But again, that's something that they need to feel better about. But you need to be aware of all of the income restrictions, right?
Very much, yeah, if you're going to continue working.
Or if you think you might work or whatever the case may be.
Yes.
So
you only get one do-over and it expires after 12 months that you first start taking your benefit.
That's correct.
And you do not want to get caught after that.
And we've had that happen before.
Yeah, sometimes then all of a sudden you're working to lose your Social Security benefit and it's just...
Yeah, it's messy. It's messy that way.
So, one of the first, it's not the first, but a really important factor when you're deciding, should I apply for Social Security, is ask yourself this question: does this income prevent me from having to dip into my other investment accounts to afford living, to make up your monthly cost of living? On the other side, if you do want to take the income, will you invest it? Will you be disciplined to invest it? Because that is what takes your break-even age further out and makes the choice of taking it early more in your favor.
As opposed to, I'm going to spend an extra $700 a month.
And then...
And at which point, that's when behavioral finance comes into play.
Sure.
And you have to guide people that way. So then the question is that if you have two people that are married, and boy, is that different. Now you got to take a look at which of the two, you got to look at their age differences.
Yes.
And you got to look at their benefit differences. An easier one is if you have the older spouse who is the higher income earner, you delay theirs because then the younger spouse can begin to collect the spousal benefit or whatever the case may be. But part of the decision making of that is the fact that you've got the survivor benefit. Okay, so if we have an age difference of 5 years and you wanted to collect the spousal, the benefit, the 67-year-old benefit, then what happens is that we look at the break-even age of that person drawing at age 62 for their own versus waiting until age 67. Their break-even age is age like 95 at 5%.
Yes.
But now it's break-even age 95, her age 95 of either one of them dying.
Yes.
Because if the spouse dies, they jump right up to the higher benefit.
And that's one of the things that sometimes, we'll talk, this is probably the most common, if I can say that, strategy that we end up recommending, and everyone's different, but the most common one I'd say is where one spouse, the one with the lower benefit, starts taking it as soon as they can, 62, allow the other spouse with the larger benefit, delay it as long as possible. And it kind of is as simple, like you said, it's the survivor benefit. Oh my gosh, I'm giving up, I'm taking this early, I'm getting this massive reduction. No, because if either of you were to pass away, the only thing you lose is that lower benefit. And that's why it tends to be not the only recommendation, of course, because everyone's different, but the most common recommendation we make with Social Security planning.
Now, you can get super tricky. What I've done before with two spouses who are self-employed is, and I've got all kinds of different spouses. We just did one now. Okay, they're both employed, and one is 65, the other one's 61. Their benefits are roughly the same.
Yep.
Okay, so the full retirement benefits, both of them were like within $50 at $3,500. Okay, so what I said, look, I said, wait a minute, they're self-employed. We just drive all the income to him, who's 61.
At the IRS legal thresholds.
No, he could, right, well, whatever, but we can drive all the income to him,
Yeah.
and then she's 65, we're having her begin collecting,
Yeah.
okay? Because then she begins collecting, and then once his gets to, and by the way, they're planning on continuing working the business for at least 5 more years, at which point, then he turns almost 67.
You can earn as much as you want.
And then not only that, he goes on to his own full retirement age, which will be higher than what hers would have been. So in effect, we're grabbing the money for her.
Yep.
Okay, so, and then what we do is, because they're business owners, they have the ability to drive their own income. If they wanted to pay her, they could pay her $22,000 a year, imagine that, and slide it underneath and use it to be contributing to a 401k or whatever works for them.
Yep.
Okay, but you keep that person under that, and that's great. Now, I did that a second time. Okay, and what I did here is the ages were different. Okay, what I did, not only that, but they also had different incomes. And because of the way it's calculated as a benefit, the wife was more than half of his. So they would always be collecting their own benefit.
Yep.
But he was up at the point where he was making into 15%.
Okay. Yeah.
And she was into 32%. So what I did is I had him begin collecting the Social Security benefits and driving all the income to her.
Yep.
Because it grew her benefit more, kept his income under, and by the time she would have turned, it worked
Because
well.
the weighting of the income and how it, how it.
Okay, it worked really, really well. You got to work it. You got to understand the math behind it. But again, he who knows the rules of the game typically does better at the game. And you know what? Not a single thing we ever do or recommend to our clients is illegal. It is absolutely within the realm of what you're allowed to do. I mean, you're allowed to allow one spouse to collect and not the other, and you're allowed to do all these different things. We're doing nothing illegal, nor are we recommending anything illegal.
Yep.
So,
system.
Yeah, you just got to understand the system.
One of arguably the most important thing when you're deciding if you're going to take your Social Security benefit, because this could change the course of a conversation we have in the matter of a moment, is just what you think your life expectancy will be. I've had people say my parents both live into the 90s. I fully anticipate that. Me and my spouse are healthy. What have you. Generally speaking, it takes a lot of other factors. Social Security is not your only income. You have potentially other assets. But generally speaking, if you have a longer life expectancy, you want to have higher guaranteed income.
Right.
There's very few forms of guaranteed income in this day and age. Pensions have gone more or less by the wayside. You see them much less commonly. Social Security is the only form of guaranteed income you have as an American citizen because you paid into it. So if you expect to live longer, you generally speaking want a higher floor, an income floor, by delaying your Social Security.
Right.
I've gone through conversations with people where we're saying, we're looking at delaying it because your X, Y, and Z factors look at delaying it, but then you ask, what's your life expectancy? both my parents died in their early 60s, 70s, I'm not very healthy, I've got X, Y, and Z going on with my body, then you have to make a joint decision as a team. It's like, well, hey, the risk of you taking it early is that you might live longer than you expect and your income might not keep up with your needs. But you have to live for today. And that's a really interesting
that's a tough
balance to make. But that's when, if you tell me the day you're going to die, I'll tell you exactly when to start collecting Social Security.
Both die, right.
But that's where you have to that's the really hard thing about Social Security. There are more people afraid, there are more retirees afraid of running out of money than they are dying in retirement.
It's a Harvard study.
And it's, I don't know how they calculate that, but it's life expectancy is really important when making this decision. So if you think you're going to have a long life, it might behoove you, based on a lot of different factors, to delay it. Versus if you think you might have a short life expectancy, then get your money while you can. Because
it all comes down to evaluating your circumstances, because you got differences in income, you got differences in age, differences in life expectancy, other sources of income, goals, objectives, etc. So we're going to stop here and we're going to go to break. And what we're going to do is we're going to pick up in the last segment. We're going to talk about the taxation of Social Security. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained. I'm your host, Mike Menninger. I'm here with my co-host, Kyle Ryan. We're continuing on for the last segment of the Social Security and Social Security planning. And what we're going to talk about is the taxation of Social Security. And I always like to ask clients, is Social Security taxable? And there are usually three answers I get. Yes, I don't know.
I thought you were going to say the last.
And no.
Yep.
Okay?
Yep.
It's usually yes.
I've gotten a maybe.
Maybe. All right. There's four. That falls into the I don't know. And the long and short of it is, it goes back to the answer to almost every question is, it depends.
Of course.
Depends on what?
Your other income.
Your other income. And it looks at all other income. It could be pensions, it could be interest, dividends, capital gains, you name it. All of your other income counts. So what we did is we created this little chart that you could see. Hopefully you can see it if you're watching. If you're not watching, then you have to hear what I see or see what I hear or whatever. Hear what I'm saying or something.
Verbally visualize it.
Right, there you go. Verbally visualize it. So what happens here is what they do is they take all of your other income.
Your taxable income.
Right. Including interest. Maggie, muni interest.
Yes.
Okay.
Yes.
So it's not just taxable income. So it's all of your other income. Really, it's all your income.
Yeah.
So they take all of your income plus 1/2 of Social Security. And they come up with a number that's called provisional income. It means nothing other than how do they tax it. So they have the married and then they have the single. So what we did is we created an example here where you have a married couple who have $40,000 of other income. It could be dividends, capital gains, pensions, IRA distributions, interest, you name it. They got 40 grand in other income.
Yep.
And between the two of them, they've got $3,500 a month in Social Security, which is $42,000 a year. So in this particular example, we take the 40,000 other income plus 21,000, adds up to 61,000, and to determine how much of it is taxable, they slap it up against this chart. And what they do is they say from 0 to 32,000 for married is at 0%, my favorite tax rate. From 32 to 44,000 is at 50%, and anything over that at 85%. Now, that doesn't mean you're paying 85% tax. Remember, all this is doing is determining how much of my 42,000 is taxable, and it's capped at 85% of it.
I've gone through this with people before, and the when I tell them it's 85% is taxable and
As
not
opposed to
tax.
tax.
'Cause
Yeah, I mean, it's like 85% tax. They're ripping me off and they're doing this.
I already paid tax.
That's right. Then now they're taxing me again. I love it. I get it. Yeah, we get them all. Welcome to our world. So what happens is we go through this calculation to determine, again, if and how much. And as we show here, you see 61,000 from 0 to 32. 0% of 32 grand is 0. Then from 32 to 44, which is 12,000, 50% of 12,000 is 6,000. In this example, we have an extra 17,000, which is taxed. 14,450 of it is taxed, which means that take the 6,000 plus the 14,450, and what they're doing is they're going back to their tax return and they're putting it in there as $20,450 of their Social Security is taxable.
Yep.
Which is great. Okay, so if we project out what their tax brackets are going to be, most people, particularly if they're married, middle income people, land in the 15% tax bracket.
Yep.
So they're getting taxed 15%, right? One might think. So that 20,450 gets put on their tax return. So you figure, okay, we got 40,000 plus 20. So now we got $60,000 AGI. Subtract out the amount that they're going to have for itemized deductions or the standard deduction, or under the new tax code, they're going to have new old tax code, the exemptions, whatever. Let's just say they reduced their income by 30 grand. Their taxable income is about $31,000. They're square in the middle of the 15% tax bracket. Cool.
Seems
They're in the 15%
pretty
tax bracket.
straightforward,
Yeah, exactly. Not so fast. Okay, because here's what happens. In reality, is that if they took on an extra $1,000 worth of income, let's say, hey, I need to take another 1,000 out of my IRA, or my RMD is up by 1,000, or I have an RMD now.
You did an odd job working. Who knows, right? You
Right.
get $1,000 taxable income. Yep.
So what happens there is that $1,000 now, instead of it being 40,000, it's 41,000, right? Plus half of Social Security. Instead of my provisional income being 61,000, it's now 62. So it went up by $1,000, which means my taxable income just went up by $850. Okay, well, guess what? $1,000 for my IRA plus $850 ends up meaning that my $1,000 of IRA income actually resulted in an extra $1,850 in taxable income. And at 15%, that's $277.50, which is 27.75% tax.
Of the $1,000 that you had just taken out. So did you pay 15%? You said you're in the 15% bracket, but you paid 27.75%.
Correct. And that's because of the taxation of Social Security. And I refer to it as the phantom taxation of Social Security. Kind of developed that word because I've never, ever, in all of my years of working, have ever seen anybody address this issue. And what's also amazing is we have to teach a lot of the accountants this, because they see me doing Roth IRA conversions and we're paying 22% tax. They're like, Mike, what are you doing? They're paying 22% tax. Yeah. When they retire, they're not going to have that. And I'm like, has anybody ever shown you, do you understand the taxation of Social Security? And then the other thing too is if you look at the history of tax brackets, is they could easily be in a 25% tax bracket where this is happening. And if they're in a 25% tax bracket and 1,000 results in 1,850, that's $462 in tax that they're paying. They're paying 46.25% tax. And again, if you look at the history of the tax brackets, you also see 28% was part of the 86 tax code, which is what we're in. Okay, you hit the 28% tax bracket when this tax code came out as a married couple at 40 grand. Okay, and they could easily be paying 28% tax, but using that 1,000 equals 1,850, that ends up being $516 worth of tax on $1,000.
We'll sit across from married couples, single couples. If you're married earning less than 400, if you're single earning roughly less than 200,000, we can look you square in the eyes and say, you earning as much as you are today will pay more in taxes in retirement when you have virtually way less income than you do now than the tax rate you're paying today. Why? Because if you're in the 24% tax bracket today, you can make $400,000, married couple, and you're in the 24% tax bracket today. You go forward, you retire, and you're like, oh, all I have is $40,000 of income. It's a pension, annuity, IRA distributions, you name it. But then you throw in Social Security, and you're in a higher tax bracket than you were when you were working. And you spend all those years contributing to a 401k, what have you, taking the tax deduction at 24% or lower to later pay 28%.
And we're going to find this to be more prevalent with time, because what is happening now is the Social Security benefits are going up.
Yes.
So there are, we've got clients with Social Security benefit over $4,000. A lot of our clients have full retirement age benefits of $3,500.
Yep.
Okay, where this is really going to come into play is when you get a surviving spouse.
Yes.
With a surviving spouse with a benefit of $40-something thousand themselves,
Yeah.
and with having to take an RMD, this is going to create all kinds of issues. And in fact, that is a very real possibility that they're in the 25% tax bracket and still having their Social Security being taxable. So this is real. This is real, and it's hard to, it goes against conventional wisdom. Like you said, I can look somebody directly in the eye making $400,000 as a married couple and saying, you're in a lower tax bracket now than in retirement.
And some people phase out of the benefit, and it's not quite as bad, but still you have to pay, that extra taxation on the Social Security benefit. And also, think about the last 2 episodes we did. The taxation of Social Security, the benefits of Social Security, it's not going to become more favorable to the American public. It's only going to get more tax, benefits stripped a little bit more. Something's going to change, and it's going to be restrictive. So by planning ahead for this now and being aware of these rules, you can plan better today when we have these low tax brackets than being stuck with whatever's dealt to you when you start taking it.
Yeah, and I think we have a whole episode on the phantom taxation of Social Security. It's been a couple of years since I did that one. But it's out there, and we talk about this exact same subject. Yeah. So that's about all we have. Kyle, thank you very much for participating in this.
Pleasure.
I hope, again, it's all about financial planning, and it's all about the explanation of it. So I hope that you enjoyed each of these 3 episodes on Social Security, the nuances, the taxation of it, the strategies, and we encourage you that if you ever have any questions, please do not hesitate to call. We'd be delighted to review it with you. So thank you again. I hope you learned something. Have a wonderful day. Thank you.